Hello everyone, in this short video I'll try to explain some basic concepts of International Accounting Standard number 10, so events after the reporting period, in the context of operational case study exam and F1 objective test, because this is the topic from the F pillar on the operational level. So those of you who are studying for either F1 objective test or operational case study may be interested in this video. So generally the standard relates to the all events after the reporting period and how to treat them. So generally the standard defines what kind of events, and we have like two basic types of events. So events that are favorable in terms of financial situation of the company, and unfavorable that occur between, so they should occur after the reporting period, however should be also before the date when the financial statements are authorized for issue. And the standard provides some guidelines, so which of these events that occur between these two dates should be recognized in the financial statements and which of them should not be recognized in the financial statements. So this is the topic that is very often tested under operational case study exam, and for sure it will be tested in your F1 objective test exam. So generally so we have favorable events and unfavorable events. However, the standards just divides them into two groups. So one type of events are those events that we call, or the standard calls, adjusting events, okay? And we have the other group that are, these are the events that are non-adjusting events. So what is the difference? So generally adjusting events are those events that happen after the reporting period. However, they provide evidence of conditions that existed at the reporting date, okay? And non-adjusting events are those events that occur after the reporting period as well. However, they provide evidence of conditions that arose after the reporting date, so they have no relation to the conditions that existed at the reporting date or before the reporting date, okay? So generally in the first group, so adjusting events, so if this kind of event happens or occurs after the reporting period, but it has some relation to the conditions that existed at the reporting date, then the standard says that you should adjust your financial statements. However, if such an event have no relations to the conditions at the reporting date, but it has relation to the conditions after reporting date, then you should not adjust your financial statements, okay? So this is like general rule of IAS 10. So the basic problem is that if the event after reporting period has any relation to the conditions that existed at the reporting date, so if such relation exists, then probably you should adjust your financial statements. And if there is no such relation, there is no adjustment of financial statements. So here are a few examples of such adjusting events. So events that have relation to the conditions that existed at the reporting date. So for example, evidence of impairment of assets. So if after the reporting date there is an evidence that your assets should be impaired, it probably implies that at the reporting date your assets, so value of your assets were lower than presented in the financial statements. So these financial statements should be adjusted with the relation to this impairment. Another example is just discovery of error that existed prior to the year end. So you've made an error prior to the year end. However, this error was discovered after the reporting period. So, but before the issue of a financial statement. So if that is the case, then you should adjust your financial statements. The other examples are major customer bankruptcy, resolution of a court case that company entered into prior the year end, selling the inventory after the year end at the price lower than the cost. So that also implies that if you're selling the inventory after the year end at a price that is lower than the cost, so that suggests that at the reporting date your inventory was incorrectly valued. Okay, so these are the type of events that suggest that you should adjust your financial statements at the reporting date. And non-adjusting events, so here are fewer examples of events that happen after the reporting period. However, they occurrence do not have any relation to the conditions at the reporting date, so there is no need to adjust the financial statements. So just a few basic examples of destruction of a major asset by fire and flood. So this is just happened by accident, so it has absolutely no relation to the conditions that existed at the reporting date. Acquisition or sale of a subsidiary after the year end, and also a plan to discontinue an operation. So this is just an announcement, so it has absolutely no relation to the conditions that existed at the reporting date. Announcing the implementation of a major restructuring, so you're not doing actually anything, you're just announcing the implementation of a major restructuring. So of course it has no relation to the conditions that existed at the reporting date. And major ordinary share transactions and potential ordinary share transactions after the reporting, then this is also considered by the standard, so by the IAS 10, as a event that is non-adjusting event. Okay. And these non-adjusting events, the standard divides them into two groups. So one group of events that doesn't require an adjustment of financial statements, they require to be disclosed. Okay, so and standard says that every event that cause significant changes to assets or liabilities in the subsequent period and either will or may have a significant effect on the future operations of the entity. So if such an event occurs after the reporting period, then you should disclose it by note. Okay, and of course, if there is no material impact on financial statements in the subsequent period, there is then you are not obligated to disclose it by note. Okay, so remember that generally we divide events as adjusting and non-adjusting events are further divided by events that require to be disclosed by note and those events that do not require to be disclosed by note. And what about disclosure? So generally IAS 10 stipulates an entity must disclose a description of the nature of events. So this note should include a brief description of the nature of the event. It should include an estimate of financial effect. If this event may have in the nearest future a financial effect on the company, then you should present an estimate of this financial effect. However, if such estimate cannot be made or is you cannot present such estimate that is reliable, then you just put an information in the note that then estimates cannot be made, and that's absolutely fine. And the third element is the date that directors approve financial statements. And this type of question is very often met in the operational case study exam. So one of the subtasks that relates to IAS 10 requires examinees to present what elements should be included in disclosure note. Okay, so try to remember that these three elements are obligatory. And here we have examples of non-adjusting event that would generally result in disclosure. Okay, so these are the events that may have or will have a financial effect in the subsequent period. So we have breaches of covenants, waivers, or modifications of contractual terms in lending arrangements. So if there are any modifications of contractual terms in lending arrangements, you may expect that it will have a material impact in the future on companies' financial statements. So this is the type of event that will require to be disclosed by note. Supply chain disruptions. So again, in the future, it may have a material impact on companies' financial statements. The assessment of certain purchase or sales agreements as an one-year contracts. So this assessment has no significant impact immediately. However, it may result in such an impact in the future. So this is also a type of event that should be disclosed by note. And another example is announcing a plan to discontinue an operation. So you just announce a plan. So this announcement has like no immediate impact on your financial condition. However, it may have an impact in the future, so that we should probably disclose it by note. And here I have an illustration of how to apply IAS 10. So very like brief example. So we have a company called Trinity Limited, and it ended its fiscal year on December 31st, 2022. So this is the reporting date. So most of the companies have its fiscal year exactly the same as calendar year, but not all of them, but most of them. So 2 weeks later, one of the main credit customers declared insolvency and went into liquidation. So this is the event after reporting period. Okay. It is expected that none of the 200,000 debt is recoverable, so we probably will receive no money from this customer. However, of the total receivable amount, only $80,000 relates to the sales made in 2022. And below you are informed that directors decided that this debt should not be written off, so there is no adjustment to the financial statements, but disclosed by a note, because they decided that the liquidation was an event after the reporting date. So they decided that if it is a event after reporting date, then they shouldn't adjust their financial statements. And the question is, are they right? So the key information is here is that of 200,000 debt that that won't be recoverable, $80,000 relates to the sales made in 2022. So let's go back to the slide when in which I describe which of the events should be treated as adjusting events. So take a look at this. So we have adjusting events are those events that provide evidence of conditions that existed at the reporting date. Okay, so let's go back to this example. And as you see, so $80,000 relates to the sales made in 2002. And if you just think reasonably about this customer, so this customer went into liquidation because of its insolvency. However, your financial condition that results in insolvency is a ongoing process that lasts months, sometimes years. So it doesn't happen like day to day. Okay, so the conditions that indicated that this customer had financial problems, significant financial problems, probably were visible at the reporting date, so at the end of 2022. So this information provides an evidence that conditions that existed at the reporting date indicated that this $80,000 of credit sales will not be recoverable. So how we should treat this? Okay, so as you see, even though the client's liquidation occurred after the reporting date, so this is no doubt an event that occurred after the reporting date, it should be treated as an adjusting event, because $80,000 debt existed at the reporting date because of sales made in 2022, so it should be written off. So financial statements should be adjusted, and 120,000 debt. So this is the result of sales after the reporting date. So this debt did not exist at the reporting date, so it should be written off in the following year's financial statements, so 2023, and of course disclosed by note to inform the recipients of financial statements that this happened, and that will be written off in 2023 financial statements. So that's it for now. Take care, guys.